We are rolling. We are live. Episode 8 of the Capital Spotlight podcast, hosted by yours truly, Craig McGrother, alongside the one, the only Mr. Suit Supply himself, Rob Beardsley, the co-founder and principal of Lone Star Capital. How are we today, sir?
We're doing very well. It's another beautiful day in New York. I see you're still on vacation in Oregon. You must have a very nice boss to let you be on vacation for so long.
Yeah, you're right. Doing Zoom calls from 7:30 a.m. till, podcast at what is 1:30, all of that, and still got a jam-packed afternoon. This is what vacation looks like in the private equity world, right?
That's right. We wouldn't have it any other way.
Right, right. Well, we're going to get into a lot of fun stuff today. Just for the agenda we're going to set, we're going to talk about several things today. First off, our conference, our office, a Wall Street Journal article, which is interesting regarding commercial real estate. I'm sure many of you have seen it. In addition to that, what happens to secondary and tertiary markets as things kind of shift and change with pricing, with interest, with rents. And then actually something that's a little closer to me personally, single family home market. And then finally, Rob will be able to tell us what time it is because we're going to do a little watch talk. He thought, and I'm saying he thought he could get something past me, but not so fast. It took all of, I think, 5 minutes to notice a slight difference on my dear friend over there. So we'll have a jam-packed episode. Also, one reminder as well, we have the blood drive in the office. This will come out on Monday. So on Tuesday, if you could come by and donate some blood, just a pint, 1 pint saves 3 lives, if I'm not mistaken, or something like that. Whatever it may be, we'd love for you to come, meet and greet with us. And yeah, so without further ado, let's get into it.
Yeah,
Our
that'll be
conference.
also, yeah, the blood drive will be August 15th. And yeah, you can learn more by reaching out to us and stop by. Feel free to stop by our World Trade Center office to meet and donate some blood.
Yes, 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 yes. Thank you for the more details associated there. So let's get started on our conference. So our conference is, I think there's a pre-party at our office. So we're going to tie into that on the 15th. And then the 16th and 17th of October, 2 jam-packed days. The first day, Monday, is a full day. And then Tuesdays, if I'm not mistaken, will likely end around 1 to 2 p.m. Is that correct?
That's correct.
Awesome. Yeah. And I kind of just break through your vision of having the conference, maybe some of the work associated with it, what the goal and agenda is, how ours is in contrast to, all of the other, multifamily and real estate conferences, and maybe just tie it together.
Yeah, so this will be the third year Lone Star hosting its own annual summit. So it's been a big success for us, I would say, each year so far. And it started off pretty small. It started off with just under 40 people, the first summit. And it was very intimate. We had an amazing time. It was also very bootstrapped together. I mean, we did it out of my apartment building in the amenity space. We we did some exciting things though. We had a negotiation workshop from one of my favorite authors, Professor Stuart Diamond from Wharton. So that was an exciting experience where we all got to work closely together. And then into year two, we upgraded it, went from 40 people to just under 100 people, still kept that intimate feel where everyone kind of got to know each other and did some fun networking. Both years we always do a dinner, cigars, scotch, kind of a fun VIP theme in the night. And then this year we're doing that again, Reserve Cut, which is a very nice steakhouse, kosher steakhouse downtown near the World Trade Center. And then we're going to Barclay Rex, which is it's the oldest cigar lounge in the city. So we like to end the night there, and everyone gets to really connect over a longer format. So we're all about kind of the connections, and you were there last year, so you got to experience that and contrast it to some of the other conferences, which kind of you can feel lost in the crowd because there's 300, 500 people and it doesn't feel as intimate. So that's something that maybe you want to touch on. But last thing I'll share about this year that's unique and different than last year is I analyzed the agenda from last year. I looked at all the content that we did, which we can talk about the content, which I think is fantastic. But I looked at it all and I went, wow, we delivered a lot of amazing content, but I felt bad for how long we had people just sitting there taking notes, absorbing content. I want people engaging. So we actually are cutting down the amount of content in half and repurposing those hours towards dedicated, deliberate, small group sessions, networking, structured networking, speed deal making, and those sorts of things to really drive home more value for our network. Because as we know, it's all about the connections.
Absolutely. So I think one of the coolest takeaways that I remember from the conference was walking as a group from Reserve Cut to Barclay Rec, because for those who aren't very familiar with New York, New York's a vast and culturally incredibly significant city, of course. So we walked from from Reserve Cut to Barclay Rex, and on the way over, you pass the stock exchange and all the most beautiful buildings in the financial district, which, to me just is, it's iconic, I think, to anyone, but to me, it just was really powerful, and it just kind of speaks to the level of what we're kind of who we are as a brand, I'd say, as Lone Star. And then also, if you've not really experienced New York City much and are looking for a great excuse to go to New York, this is a great way to do that. You can come in on Friday, hang out. Maybe you can come with the wife, and then she can leave a little bit early. And then you can stay that Monday and Tuesday, network with some of the best and brightest in the business. And to your point, I think last year we did something really great, which was, the speed networking, which we will double down on, as you just alluded to, in this next conference we do. But in conjunction to that, I think we're not only going to double down on that, but whatever you're looking for, I think you can find. So let's say if you're a sponsor, there'll be private equity shops, family offices, just investors there that we can set you up with. If you're an investor looking for operators, we will have that there for you. If you're debt, you can meet the equity people, so on and so forth. And we really are pulling in the best of our network. It's a collaborative business, and we think it's not a zero-sum game thing, so everyone can win and win together. So we want you to come, and obviously if you're coming on a Monday and Tuesday and you're staying in New York, this likely won't be the cheapest endeavor or experience that you will do. So one thing that's really important to us is to make sure that we deliver incredible value to you. So we'll have really, this is the highest level of content you can have at a conference. To your point, I think we have maybe 5 or 3 speakers, correct?
We'll have 3 keynotes. We have a bunch of sharks, who are savvy, sophisticated investors. We'll have some investor relations panel and different things like that. I don't want to share too much because it's still in progress. But yeah, we always have great speakers. Our network is always willing to support us, so it's not hard to ask someone to come and speak.
Right. But the cool thing is that we're going to make it more about networking, make it more strategic. I've spoke with several people who are kind of interested, haven't been yet. And, my goal and mission as someone who's done a lot of the outreach to invite people is to really put my money where my mouth is and hold me accountable. If you're looking to meet certain people, I will do everything in my power to make sure you're connected with the right individual, to make the experience and time worthwhile, and to make sure that you have the best taste in your mouth when you think Lone Star Capital. So we want to do that not just for how we treat investors, our debt partners, our equity partners, our capital partners, the people we work with, but obviously people who are in support of us like that. So it's all really important to us, and we want to make sure we can tie it all together.
Yep. So one highlight that has been a consistency throughout all 3 summits, which includes the first 2 and this one coming up, are the deal Shark Tank panels. So this is basically Shark Tank, but think real estate. And so we have people come and present their opportunity to a panel of sharks, which include family offices, private equity firms, sophisticated investors. And it's a very fun, but also informative opportunity for everyone to learn. The presenter probably learns the most because they're the one presenting, and they get direct feedback from investors on their deal. And also we ask them, what did you think of the presentation? Okay, the deal, give feedback on the deal. That's great. But also, how about the presentation? Because as we know, we don't live in a world of ones and zeros. Humans are humans. And as much as we love to think that if I find a good deal, the money will come, the reality is who you are, how you present yourself, how you present your deal really matters. So getting that feedback in real time in an honest, collaborative way is super helpful.
Sometimes
sometimes not too honest, but sometimes very honest. We had some big laughs last year. Hopefully not at anybody's expense too much, but Yeah, that makes for very fun and informative experience. So we're bringing back the deal Shark Tank. I love it. I believe in it. So looking forward to the presentations again. Not sure what the winner's going to get this year, but that's always going to be a hit. And then something new this year, which is probably the most exciting thing, is the fact that it's going to be at the One World Trade Center, right? So we signed the lease to be here at One World Trade Center right around the time that we hosted last year's event. So unfortunately, we just kind of missed the window to host it here or to do anything with the new office space. But now this year, coming up October 2023, we'll be able to actually host the pre-party in the office. And then on the 64th floor, there we're renting out the entire event space here in the building. And that's where the event's going to be both days. And so I share this because we think that's very exciting, but also I think it's important to share for people to kind of hear why we are doing this and, why do we have an office in the One World Trade Center to begin with, right? Because it's more expensive than the alternative. And it's something that Kent and I thought a lot about when we made the decision. And we felt strongly that having an office in the World Trade Center and putting our brand with that would be worth it in the long run, and that it does establish us and give us more credibility. And we've seen that certainly be the case. And so we feel very confident. And so having the pre-party in our office to show investors, to show our partners, if they haven't been to the office yet, hey, here's who we are, here's where we are. We're not just some people on the internet or someone who you talk with on the phone. Building these real human connections are so crucial. So that's a little bit more kind of behind the curtain as far as our strategy there.
I thought you wanted to get office space in One World Trade Center because you wanted to live on Murray Street and you just wanted a convenient commute to the office. Is that not true?
Well, it's chicken or the egg or the tail wagging the dog, right? But no,
Oh,
funny, I actually chose where to live based on the World Trade Center. So it wasn't the other way around.
and how long did you have your eyes set on the World Trade Center as a place to lease?
Not very long, to be honest. So once we made the decision that we needed office space, that it was time, we got a leasing broker. We started touring space around the city. We wanted to be, in particular, very close to the World Trade Center because Kent takes the path down from Muncie. So for him, this is kind of where he would get out of the train, and then he would want to be very close to here. He said a 5-minute walk from the World Trade Center. So that was where we were looking, and we looked outside of that as well. But the reality was at the time, and I don't know if it's changed, there weren't many options for space of our size, our desired size. We have about a little less than 3,000 square feet here. And funny enough, the World Trade Center, for example, out of the 100 floors of office space here, only 20 of them are non-full floor spaces. So think about that. 80 floors in this building are full floors. So there just isn't that much available that we came to find out available in the World Trade Center and otherwise in the neighborhood that was, nice, small kind of plug and play space for us.
So the occupancy is pretty good at the World Trade Center. Is that correct?
Yeah. I mean, I think it's somewhere around 96%.
Interesting, because we hear a lot about occupancy not being very good in commercial or in retail specifically, but obviously that's very nuanced and that's a coveted space. But the A and or the A class office space is crushing it, from my understanding. Is that correct?
Yeah. I mean, you and I aren't office experts. That's not what we focus on. But from what we see in here, the A space in office, even in downtown locations that were hit hard by COVID, have recovered, have strong occupancies, have strong rents. And so, yeah, there's this tale of two cities where the B and C class office is just crushed with very weak rents and occupancy. And then the A stuff is where all the thriving businesses want to be, and they're willing to pay a premium to be there. So I think that's exciting. I'm a big proponent of the office, of downtown living, and of people getting together and being in person. So I'm all about it.
Yeah, I am too. I'm the biggest advocate for it, and no one loves the office more than me. That's why I'm there so much. How many years is the how many years is the lease?
We signed a 5-year lease.
Very cool. So we're pretty locked in.
We're locked in. Let's do it.
Awesome. Well, and the reason why we also want to tie together the conference in our office, as you mentioned, we're going to be on the 64th floor, but for the VIP attendees of the event, we'll be having a pre-party within the office. And I think the value of this is, to the point that you mentioned, we basically meet everyone online one way or another through maybe one of our various marketing campaigns, or perhaps we meet in person at a conference. But if you don't know us very well and you just get it going and you don't have office space, it's kind of like having a Gmail for your email, and that's fine. But if you want to be an elite capital raiser, if you want to be an elite sponsor, you best kind of have your ducks in a row and have it be more professional. So for us to have office space here, I do think makes us take ourselves more seriously, but also has instant credibility, because you can't really be a schmuck if you have office space in the World Trade Center. So there's many things associated with that is interesting, that, is important, maybe subconsciously associated with the office, other than the benefit of being collaborative and everyone being together.
Well, let me dive into a couple other things that are tangential to that. So when you, and this isn't just me saying this, other people say this, some of our employees on the team have said the same thing, that when you walk into the World Trade Center, it feels important, and it feels like, okay, I'm coming to work to do something important. My job is valuable. I care about it. And on top of that, we have a company dress code of a suit and tie in the office. So, you're over in Bend, knock yourself out. Don't wear a tie, no problem. But in the office, much as much as people may not believe this, Craig does wear a suit and tie. So when our team walks in suit and tie into the World Trade Center, that makes us all feel special, feel important. And I know this is kind of woo-woo, or maybe, okay, so what, who cares? But I think this is important to mention, because it's all about building the company culture and getting buy-in. And we're all bought in. We all understand how important our jobs are and what we're doing, and we're pulling on the same side of the rope. So I think those are kind of a few key things that tie together that give us a competitive advantage, right? Because we're not just sitting at home on Zoom with our video cameras off in our sweats, trying to work as little as possible, right? You're in person, collaborating in a suit and tie, feeling proud of what you do. I think that's really, really important, because the reality is we all spend a lot of our waking hours working. So we might as well feel those types of things.
I couldn't agree more. And I do love coming into the office. I do love putting a suit on. You definitely feel alive when you're in the city. You feel of importance when you do put the suit on. It's like kind of your superhero costume. And frankly, it's your dress code essentially. And it's a very much so a part of your personality trait. I actually have a really interesting story I'll dive into real quick just on that. So my grandpa, who just passed away, just went to his service a couple weeks ago, and then drove up directly from the Bay Area to here. But he was actually a very prominent attorney in San Francisco. And he epitomized being a gentleman. I think that word and was said maybe over 100 times between the kind of night before and then the service itself the day after, which makes me really proud, because I really want to incorporate that into my life. But he was very, very strict on himself about what he wore. He wore a suit and tie every single day. And as culture shifted over time to more casual Friday and whatnot, there was one day where they had to, or someone had to in the firm, drop off something to a judge. But this is on a Friday, and the office went to casual Friday. Of course, my grandpa, being the gentleman that he is, wore a suit. So he was the only person that was allowed to go there. And when the judge saw him, because he, did depositions and did trials and things like that, he said, "McGrother, what are you doing here?" He's like, and he didn't want to say to the judge, "Oh, well, I'm the only one wearing a suit." Of course, but he's like, "No, this case is really important to us. This case is really important to us, XYZ." So it was just kind of funny how he was always like that. And then my dad, I've never not seen my dad wear a suit. He worked for Morgan Stanley's, I think I've said on the show. Even in the Bay Area, he'll never not wear a suit. So every single day, doesn't matter if it was a Friday, doesn't matter if it was a Monday, 5 a.m. in the office wearing a suit, home at 4 p.m. wearing a suit. So it's definitely in my blood. So I'm happy to do it. When I'm in Bend, probably not going to wear a suit. When I'm in Scottsdale, I will not wear a suit unless I'm going to in a meeting or a conference, something like that. But I do love that culture, and I hope that's something that doesn't dwindle too much as time progresses.
I agree. That warms my heart. And what's exciting is we're going to be back in action in person for next week's episode. So we'll be in the office recording the first podcast in the office together. So I'm very much looking forward to that.
Likewise, it's always more fun to do it that way and whatnot. Well, segueing in now to the interesting article that our whole firm was kind of diving through and discussing and whatnot. And I'm sure many people have the Wall Street Journal article regarding the commercial real estate situation, and not just how it was for offices, which has been well covered, but now the shift and what people are talking about with multifamily housing. So I know you've probably read this several times. I don't know, are you pulling the article up right now? Just maybe go through a couple of the excerpts, but it's really interesting kind of what this was discussing. And, I'd love to hear your thoughts on this, how you dissected it, and how it landed for you.
All right. Yep. Let's dive into this. So the name of the article is "With 1 trillion coming due, a real estate safe haven turns perilous." So the idea of this article is that the premise is that commercial real estate distress, specifically office and retail, is well known. But basically, this article is arguing that multifamily has kind of been under the radar as far as its distress, and it's not getting the attention that it deserves. So let's kind of unpack that. It first says that apartment buildings are long considered a safe haven in the real estate world, which is true. If you look over time, multifamily is typically more resilient, less volatile than the other asset classes, and performs well in a recession, with kind of the typical trope of, well, everyone needs a place to live, so multifamily does well. And then the article goes on to make some interesting claims. It's like this Peter Sotoloff guy says that multifamily is facing a hydrogen bomb scenario, meaning foreclosures and distress and things like that. CoStar says that multifamily values are down by 14% for the year ending in June. I would say that sounds maybe on average probably about right, but in reality, I think that the deals we're looking at, I would say the values have fallen a bit further. So, but with that being said, the article also says that values went up 25% the previous year. So if it went up 25%, down 14%, multifamily is still doing strong as on a value basis. I mean, we still look at multifamily and think it's fairly expensive and that there's more opportunity to be had. So, but with that being said, it's resilient. There's a lot of capital in the market still. So another interesting thing from the article is talking about looming maturities. So there's about $1 trillion in multifamily debt that comes due between 2023 and 2027. That's a interesting statistic, but I don't think that's as meaningful as the statistic that I heard the other day, that I think it's 30 or 40% of the mortgages that are coming due in 2024 as of today cannot be refinanced without cash in proceeds. So that's across all asset classes, I believe. But basically, let's just take the lower number, 30%. That basically means 30% of all loans maturing in 2024 are going to need a capital call of some kind, or a bridge to bridge bailout to get them through that difficult scenario. So that's a big deal.
Or they'll just lose money, right?
Or they're a forced seller and they'll have to sell and likely take a loss, right? Selling at the exact wrong time, because when there's a credit crunch, that's when prices are lowest. So yeah, you want to avoid being a forced seller in that regard. What else was interesting in this article? I thought there was maybe one other interesting point. I mean, I think, right, they're shining light on multifamily, and I think this is true. I think for the most part, a lot of people kind of think that maybe their head is in the sand and they think, oh, everything's gonna be fine, we'll just be able to ride this out and multifamily will work itself out. I think there's going to be some challenges, and I commend Tides Equities, which is called out in this article. Tides is one of the biggest players in our space. They bought $6.5 billion in property since 2016, and Tides has been very upfront in a letter to its investors saying, "Hey, we have some serious debt problems in our portfolio. Probably, I forget the number, but maybe 20% plus of our loans or our deals are going to need capital calls. There's a big cash need there to kind of restructure their debt, rebalance the portfolio." And in an interview, the founders of Tides said that they're working with lenders on ways to avoid default at properties that face difficulties, right? So this is something we've talked before on the podcast about how borrowers are going to want to work with their lenders, extend and pretend, get some relief and things like that. And that's going to work, but only so much. At the end of the day, if there's negative equity that needs to be fixed, there's going to be some cash that needs to come to the table. And it's going to be an interesting question of whether or not that cash is going to be there. And it comes down to relationships and your reputation. So even though Tides has gotten a lot of what I would call bad publicity because they're kind of looked at as the scapegoat for having floating rate debt and for having a lot of these issues, the reality is they're potentially going to be more okay than a lot of the smaller owners that have less relationships and have less established of a business to survive, right? The smaller, I hate to say this, but smaller syndicators that have the same issues as Tides are more likely to go out of business completely because they only own a few deals, they're getting crushed by the floating rate debt, and they don't have the wherewithal to ride out the downturn and make those very big capital calls to stay alive, and they just have to walk away. So that's something that jumped out at me is, hey, Tides is getting a lot of blowback in the media, but this isn't unique to them. This is, as we've discussed, a market-wide problem.
Yeah, and I think you mentioned something that's really interesting is that, smaller groups couldn't get away with, what is going on with some groups that are bigger that are kind of experiencing some issues, right? Whomever that may be. For instance, I think if we were having, rampant capital calls, if half our deals got capital calls or more, we might be in a situation where we might not be able to do business for the foreseeable future, or might have to close our doors, unfortunately, which is scary to think. Fortunately, we have maneuvered essentially every single deal into incredible debt situations, and we did not scale too quickly during the hot times. And I think I tip the cap to you and Kent and team prior to my existence being there, of not buying everything and that moves, and being very pragmatic and I guess practical and conservative in the underwriting. I know many people say that. I'm sure every investor person, every person who does the outreach and the calling and whatnot says how conservative they are and their approach, but how practical is that actually in reference to implementation and actually being disciplined when the market's going crazy, when everyone wants to buy real estate, when cryptos and NFTs and everything else in between is going haywire and red hot, to exercise discipline and be more thoughtful for your decision making is just a great lesson for us to kind of cement down and to think about as time progresses. But it really is awesome that we're positioned where we are, and we can actually be in the position to, as H2 unfolds and 2024 to 2025 come, for us to actually play offense as opposed to playing defense, and not worry about problem childs, and not worry about investors saying, I will not invest with you ever again, and having to reinvent the wheel and do all the outreach and everything like that, as opposed to being able to retain and hopefully create referral situations where people want to, throw us more equity as, time progresses. Fortunately, there will likely be some fallout here of, investors being a little snake bit, maybe having to get capital called, or having their monies get diluted, and being a little bit skeptical of that. Hopefully that's not, and ideally not on our watch, of course, but it is something to think about as we move through this interesting period. And you really did hit the hammer on the nail there. If debt's coming up 2025 to 2027, that's not really what's going to scare me. Maybe the front half of 2025, but 2024 will be a crazy year. We've got a ton of bridge debt and floating rate debt that will come due, and rates don't really seem to be coming down anytime soon. I will not listen to what any speculator will say anymore. I'll just take the current debt right now and take that deal moving forward. But we also have an election year in 2024, and depending upon how you view politics and whatnot, some would say one party will be better than the other. Who knows who the GOP is going to throw out? Who knows if, Biden goes back, not to get political, and reruns again, or what that looks like if he steps down and whatnot. So there's going to be a lot of potential drama coming up in the next, call it, let's say 20 months, frankly. That will be really interesting for the business. And, for folks like us, hopefully we can expand while other people are contracting.
We certainly are expanding, and we're being smart with the expansion. Like I told you this morning, we're planning on making a new hire soon. So I'm really excited about that. Just beefing up our infrastructure and making ourselves more competent and robust as an organization. So, and then another thing that you said that I really like, which I'll build on, is this concept that it's hard to prove yourself in good times, because when everything's good, you don't have the opportunity to show how you handle bad times and how you handle challenges. Do you get emotional? Are you solution oriented, or are you combative, and things like that? So fortunately, I have to say, fortunately, we've been through some difficult challenges with some partners, and we've been able to prove ourselves as fantastic partners in those difficult times. And I think that builds the relationship that much faster and makes it stronger. And I'm excited to get through whatever challenges come our way and the market's way, and to show everyone how resilient we are, how thoughtful we are, how much we really care about putting our investors first, delivering a first-class experience for everyone that we work with. And that way, on the other side of it, we've earned more of their trust, and we can continue to do more business with them. So anyway, that's the Lone Star commercial for today. I feel like we've been selling the summit. We've been selling ourselves. Speaking of which, if you do want to attend the summit, we forgot to say it's lscsummit.com. So go ahead and check that out there.
How dare I not shamelessly plug us any more than I typically do? But yes, lscsummit.com. Get your tickets. And yeah, awesome. So I also want to mention, can we go back to the article, please? Because it mentioned a couple of places that I find interesting, if you don't mind. So it says there, I believe it's on the final page.
So I know they mentioned San Francisco, Houston. Let's see here. Los Angeles, Houston, and San Francisco have defaulted on loans against thousands of apartments. Blackstone defaulted on 11 deals in Manhattan.
So I want to dive into that. So just real quick on the Houston note, because we have a lot of properties there, our performance on everything has been exceptional, and we'll have our quarterly co-GP call, I believe, this week or next week to kind of review that. But rents have been really good. There was that one sponsor who defaulted on hundreds of millions of dollars of real estate. That's what happens when you put mezz and floating rate debt together and raise essentially about 10% of equity. You get really aggressive, and the market can kind of slaughter you. And that's essentially what happened there. Never want to see that, but unfortunately that's there. But what I did want to talk about is buying for cash flow and what kind of can happen sometimes if you just buy on speculation, which is appreciation buying. In San Francisco and Los Angeles and New York are probably more on the ends where you have to raise, just with pricing there and cash flows, it's really incredible. And multifamily with rent control makes things very, very difficult to work. And you better hope you get appreciation. But we know a lot of people that have invested in San Francisco. And I remember when I was doing Bay Area real estate, and I have a ton of friends that have been commercial brokers, selling units in the Bay, and they haven't really seen rent pops. And, people are buying on negative caps at 2% caps with debt that's not the best. So unless you bought essentially all cash or with heavy leverage down, you might be in trouble there. But I definitely think that a lot of people, if you were kind of syndicating in San Francisco and you weren't buying for cash flow, just purely on the speculation, you're going to be in a lot of trouble. And I actually met with someone while here in Bend, someone we hope to do a lot of business with in the future, great guy. And he was just saying he right now for his portfolio, for his capital raising, he's a fund manager, and he's looking for deals with 8 to 12% cash flow. So 8% cash flow for the deal is what he's looking for, because that is essentially guaranteed. Now he's looking in more secondary and tertiary markets, which we're going to get into, or some of these places are throughout the fund. But, on his end, he knows that he can hit his numbers just based upon the cash flow, and any appreciation upside is just gravy there. But it just kind of goes back to buying on those fundamentals. And, at Lone Star, what I tell people is we like to be in that, call it 4 to 8% cash on cash range with a nice blend of, equity multiple and lifts associated as well. But I just thought that that was kind of interesting to kind of to note and talk about.
Well, I can't believe you used the G word just now.
Which is
Guaranteed. Yeah, the buying on cash flow is obviously much safer than buying for just the appreciation. Of course, cash flow is not guaranteed. Your rents could go down, your occupancy could go down, bad debt, unexpected expenses. One of the reasons, I mean, yes, like you said, our Houston portfolio is performing very well. We're seeing rent growth continue to be strong. However, Houston is experiencing some of the worst increases in insurance across the country. So if you were an owner of multifamily in Houston and you find yourself your insurance doubling, your property taxes going up, your floating rate loan is suffocating you, that's a big, big problem because you have operational challenges, right? So your P&L is struggling. And at the same time, you have capital challenges specifically from your debt side. And so those two things put together can really make the deal have major challenges. So when you have one or the other, that can be okay. For example, if you have conservative long-term debt and your property runs into short-term challenges with evictions and collection loss and things like that, you can ride it out and you can survive. If you have a well-performing property, but you have debt problems like you're over-levered or your floating rate has gone up on you, that's also more manageable because at the end of the day, you have a well-performing asset that's going to be financeable by a host of lenders. And so that's actually something that we wanted to bring up as well, is we were talking about secondary and tertiary markets, as well as the differentiation between deals that qualify for stabilized loans or long-term fixed rate debt versus bridge loans. So as many people listening know, in 2020, 21, and early 2022, bridge loans were the hot commodity, and it didn't really matter if your deal was stabilized or not. You would just opt for a bridge loan because it was so cheap and you could get a lot of leverage. Now, so what that did is that distorted pricing. It made it so that stabilized deals and unstabilized deals pretty much had the same price because they were financed the same way. Now, the premium is being restored because bridge loans are so much more expensive than permanent loans. A bridge loan today is, let's just say, 9%, even 10%, and a permanent loan is 5 to 6%. So that delta there is causing a price discrepancy because naturally, if you're a buyer that needs to finance with bridge, you're going to be willing to pay less because your interest is so much higher. So that means there's a premium for deals that are stabilized today. So as an owner, if you're really trying to preserve value, then you want, obviously, sometimes you don't have a choice, but you want to be stabilized, obviously, than not. Whereas you could get bailed out by the market a year or two ago. You could have an unstabilized deal. You were a bad operator, bad financials, and you'd still sell for a top price and make money. So that is something that's coming back to the market. So if you're looking for opportunity, like you said, going on offense in 6 months or a year from now, the biggest opportunity is going to be actually in deals that are not stabilized, because those are going to be the ones with the most price reduction because they're the most difficult to finance, right? There's no free lunch. You're not going to get a deal that's a home run deal, but then easy to finance, right? It's going to be a home run deal, but it's going to be hard to get debt. It's going to be expensive. And then raising the equity is going to be a nightmare. So pick your poison. Making money is never easy, but that's coming, and that's an interesting breakdown. Do you have anything to add to that, or do you want to move to the tertiary discussion?
Yeah, well, I just want to bridge the conversation together to secondary and tertiary markets. So on your end, what were you experiencing between primary markets, call it like Dallas and Houston, which we know most, and call it the Lubbocks and other areas like that? Where were cap rates when the market got crazy? Was there that much of a spread between the two? Because obviously now that is widening substantially, and even Dallas and Houston has a gap, and Austin to Dallas has a gap, and San Antonio to Dallas has a gap, right? So they're all a little bit different. But what happens when the market shifts to secondary and tertiary markets? And, will we start getting paid for that if you take that risk? What does that look like on a cap rate basis? Kind of walk us through all of that.
Yeah. So what's fascinating is when there's a lot of money in the world and people are aggressive, they get priced out of the primary markets, like a Dallas. So then you're willing to go to a tertiary market of Dallas, or just a tertiary market in general, like Wichita Falls or Lubbock, which are tertiary markets of Texas, right? These are smaller cities. Generally speaking, right, an investor would prefer to invest in a bigger city with more growth dynamics than a smaller city. So how do you overcome that difference? Well, I need to be able to buy for a better cap rate, a cheaper price in the smaller city. That's kind of the general rational investor. But when the market's hot and everyone's going crazy, you just want to get your hands on any deal. So all the buyers getting pushed out of Dallas, getting priced out because it's so competitive, they'll go and crowd Lubbock and then bid up the prices there. And so what ended up happening is there was very little cap rate dispersion between primary, secondary, and tertiary markets. So it didn't really make any sense to buy out there. But, of course, people were kind of pushed out to do so. And now that the cycle is correcting, we anticipate to see more of a reversion back to the norm, which is dispersion of cap rates between these different markets, right? Dallas should be a 4.5 cap or a 4 cap. And then if you're going to go to a tertiary market that's still quality, like Lubbock, we're using that example, well, it should maybe be 100 basis points wider. It should be a true 5 to 6 cap even, right? So there should be that range. And if you're buying in a junky market that has very bad growth prospects and it's very small, like 100K population, well, that should be like a 200 basis point or more premium in cap rate to the primary market counterpart. So we don't really, Lone Star doesn't really play in the secondary and tertiary markets anymore, right? We're really sticking to Dallas, Houston, San Antonio. Those are primary markets. Yes, there's a little bit of cap rate difference between them, but they're still primary markets. But with that being said, yeah, there's going to be a lot of opportunity in the weaker markets, the smaller markets, where the prices really should go back to their normal cap rate ranges, and you should be able to buy it for a 6 cap, maybe even mid high sixes, right? That sounds pretty good. So there's some opportunity there for some people who might be interested in that strategy.
You might get some positive leverage out there on, some deals, which is nice. So finally that's there. So that's awesome. Anything else you want to talk about on the secondary and tertiary market?
Something also interesting to add would be the availability of debt. So something unique, maybe going back to the article. Actually, the article did mention Fannie and Freddie as a fantastic source of capital for multifamily. And this is true. For those that aren't familiar, Fannie Mae and Freddie Mac are government-sponsored enterprises that provide debt to the multifamily market. This is unique to multifamily. You can't get government-sponsored debt for an office building, right? Because Fannie Mae and Freddie Mac have a mission to provide liquidity to liquidity to the housing market, right? Especially affordable housing. That's part of their mission. So that's something unique and is enhanced liquidity to multifamily. So in the worst of times, Fannie Mae and Freddie Mac are still there to provide liquidity. However, they only finance, generally speaking, stabilized properties with occupancies at 90% and above and strong in-place performance. So all that good liquidity goes out the window if you have a deal that's half vacant and super struggling, right? So this goes back to the opportunity. If you need to finance, okay, it's great. You have Fannie and Freddie there. But if you can't, then you're going to have to sell for a lower price so that a buyer can come in and either pay all cash or they can pay and afford to pay a very expensive bridge loan. So if you think about where could you potentially get the biggest returns, it's by taking the most risk. It would be buying in a tertiary market on a destabilized deal with a bridge loan. If you buy the right deal, that could pay off to be the highest returns, but it's also the highest risk because a lender is going to charge you even more interest out in a tertiary market. And if you don't turn the deal around, you could be in a bad situation. So it's all about balancing risk and return.
Where would occupancy be for something like that? Would that be like an 80% occupancy situation or 70% even for the risk?
Well, so Fannie and Freddie will sometimes do deals at 85% occupancy. So that's on the cusp. But I would say the sweet spot's going to be somewhere around kind of 70 to 80%, because even lenders may not want to lend on a deal that's half vacant. That's even challenging in a good market. So that's really tough.
Awesome. Very good. Well, wrapping up that into something that I know very familiar due to my 7 years of experience prior to Lone Star is the single family home market. So I know this is something that's not, I mean, Rob's obviously really schooled and well read on everything and logical. So this is nothing crazy, but I do find what's going on in that market interesting, and it does generally tie into the correlation of the multifamily market, because I think more people would rather own their house, like the tenants would rather own their house or rent a house, but obviously affordability is an issue for many people. And obviously, saving money has never been harder or never been more difficult with inflation and things like that going on. But it really is crazy to see where mortgage rates are. So I texted one of my lender friends today, so I'm pulling up my phone to pull that. And he's saying basically with 720-ish credit score, which is kind of the threshold that gets better. And he does wholesale direct to Rocket Mortgage, which is awesome. So you can get basically wholesaling loans or pricing like warehouse loans, and then they basically pay them as like a third party person, and that mortgage rate is at a 6.5. If you're more of a conventional, if you're at Wells Fargo and whatnot, and that's for a conforming loan, not a jumbo, and if you're at Wells Fargo and stuff like that, it's closer to a 7%. So I have sold houses before in 2020, 2021 with interest rates at 2.5%, where they had almost put less down than what their interest rate was, and they've made buku equity. And I've sold places, that for people that have had, I would say mostly the homes that I sold on the buy side were kind of a rate between 3% to 4.5%. So what that means is that there is a ton of people that have this debt that won't exist and we may never see again, maybe at least for another 2 decades. But in conjunction to that, you see all these studies that more homes than actually that are not are fully paid off and in our own free and clear. And then in addition to that, we've got so many homes that are owned at below a 5% interest rate, and there's so much equity in these properties that why would I ever sell or refinance? So there's kind of an issue right here moving forward for a couple of parties. Number one, lenders. So if you're a lender, I mean, you can do a HELOC if you have equity in the property, but there's going to be all this ghost inventory that will never be sold or refinanced again because they own such good debt on it, or they have its own just paid off. So why would you ever do that? And then those people, and then agents are going to have less transaction volume due to velocity going down because so many people have locked in great rates, and it's just more expensive to move than it is to stay put. And then I think another thing that's fascinating that we'll see is, let's say if you lived in Denver and now you have to move to Nashville for work, right? Well, if you bought your house in Denver and you have a sub 4.5% interest rate, and then you're going to move to Nashville and take out a 7% loan, are you going to rent in Nashville and sell your place? A lot of people are just going to hold onto their property, make it a rental, and take that monies that they would spend, for a mortgage, and then just rent there and maybe figure it out if they like it or not, and have the option to go back to, the Colorados or wherever they're coming from. So with that said, I definitely think we're going to see a stranglehold on inventory in the marketplace. And I don't think the housing market is weak by any means. I think inventory and velocity will be incredibly low for the next probably 5 years until rates come down. And even so, I think so many people are sitting on equity that won't be unlocked. In addition to that, which I find fascinating, is some of the firms, I think like BlackRock and many other private equity groups and whatnot, are raising billions upon billions of dollars to buy houses in large bulk. Zillow is doing this. Open Door is doing this. Many parties out there are doing this to own homes to make them single family rentals. There's built to rent communities and such. But I do think that will be a theme moving forward, where there'll just be a ton of ghost inventory, and they'll just look at this as, a commodity, as a stock, where, hey, I own this property here, I'm going to get some appreciation, and then I'm going to get 4% cash flow, and blended together, it's called 10% return. Well, that beats the, the S&P 500. So they're going to look at it like as a mechanism like that. And that will actually, unfortunately, impact too. Well, they're not buying the $1 million houses. They're not buying the Aspen summer homes, or, houses in Nantucket, or, penthouses in New York. They're really buying houses that are sub $600,000, called $300,000 to $600,000, which is, more often not, in a lot of places high end, but kind of, a lot of starter homes for many people. So it's a very interesting situation. A state actually like Texas, which is cool, has banned private equity groups and big kind of conglomerates like that from actually purchasing properties there to make sure that Texans can actually own, homes, and it doesn't make the housing crisis worse. And then in addition to all of that, I know this is getting long, but development, there's already been a shortage for single family home production. But when markets change, guess what happens? Units aren't going to get built because it doesn't make sense. No one wants to, take the risk right now, unless it's a how could you not deal, but that's rare. And then single family homes stop being built because they need to make a certain amount of money and sell these properties when the market's solid. I remember actually sold a client a new build, and there was a lottery system for 4 lots. There was 50 people there, and if you weren't on the Zoom call to be there, you weren't going to be able to receive, if your name got called, an opportunity to purchase the lot and then build your house, which takes another 18 months or so. So the frenzy was pretty crazy, but we're going to have some very interesting long tail issues with the single family housing market due to kind of the things that is laid out. And I'll be curious to know your take on all that, but I think that the housing market will be a little bit more resilient than people give it credit for, unlike the '08 situation when there was rampant foreclosures. I think most everyone's got fixed rate debt on these properties, 30-year debt, 30-year deals, and rents are still really strong for single family homes. So in a pinch, just rent your property out or take a HELOC out. But because of that, inventory is going to stay really stagnant. So I'll turn the floor to you.
Yeah, well, with low inventory, I don't know to what extent, but it has to be contributing to propping up single family home prices, right? With less inventory, that's distorting the supply and demand. There's less houses coming for sale. The buyers still want to buy, and they have less product to pick from. So they're going to bid up those deals. So you would think that with mortgage rates doubling and tripling, you would think that home prices would have to come down, but they really haven't come down very much. And I think that's in part due to the lack of supply, right? So
I think 2 things specifically, not to cut you off, but it's creating really high payments and bad options, or I guess 3 things: high payments, bad options, and competition still crazy enough.
when you say bad options, you just mean there's not a lot of supply on the market, so
No.
people they're gonna just buy whatever house they can buy. Well, the other interesting thing is just zooming out, I think that home ownership in America has peaked. And I don't remember exactly when it peaked, but I think it's peaked and now it's just on a decline. Is it just going to be on a secular decline to zero? No. I mean, people are always going to own homes in America, but I think that we are trending in that direction where the affordability of owning a home is going away, right? The amount of people that can afford a home is just getting smaller and smaller. And the gap between rentership and home ownership continues to grow, which is a sad thing for the country. I think it's a good thing for multifamily, right? It's a good thing for our business because one of the ways that we lose tenants is because they go off and buy a home. But if they can't afford to do that, then they're going to be tenants with us for the long term. And that's going to help multifamily fundamentals and demand.
So I just thought about this and what you said, and it's interesting, and we'll see how time progresses. But, I think many people believe that owning a house is it's the American dream. And it also really helps with retirement because you can do a reverse mortgage at a certain time, or if you own your property free and clear, you buy your 30, pay it off by your 60 if you let the 30-year note go, and now you have incredibly low expenses and you can live a lot more comfortably. Maybe your social security kicks in, you have a pension, something like that helps. But the American dream, if that's said and that's true, maybe there's a new chapter to the American dream. But if that is the case, the old paradigm of what that was will definitely be dying, which is, an end of an era. It's kind of sad. I personally want to have a very nice blend of owning single family homes. My goal in life is to try to buy and never sell any of the real estate that I personally own. Obviously invest in Lone Star, where it's a little bit more of a large scale flip in many respects, which is running the business plan and maximizing that out. But I do want to own some single family homes just from my experiences and stuff. And, obviously if I can buy those and if I have children one day, maybe they live in those houses and I can set them up nicely. That's kind of in the back of my head, something that could be productive for all parties. But it is fascinating that to your point that maybe it has peaked, and a lot of people look at it like, nah, I don't want to deal with the maintenance of it, and I like the autonomy and the flexibility of being able to invest in other things if they can afford it. But to your point, I guess it does benefit our business if affordability gets worse. We are kind of that workforce range, which is accommodates many people in the income spectrum, and likely, being in that, not the upper end, not the A class units, but kind of more in that B, maybe A minus, C plus range, lets us rent to more of the nation than not, which is great for us.
Yeah. And as far as the American dream, I think another contributing factor aside from affordability is a cultural shift, right? A lot of people, there's a lot of things that play in this for this cultural shift, but you have delayed household formation, right? People are getting married and having kids in their 30s rather than their 20s. So that means people are renting for longer. And then also going back to the affordability thing, well, it's not as easy for them to buy a house when it comes time that they want to. So then they kind of go, well, screw this whole idea of saving for a down payment and buying a house and whatnot. Why don't we just optimize for lifestyle, right? So I think lifestyle has kind of become this buzzword where people want to have that, like you said, freedom to travel and to not be bogged down with a home and things like that. So whether that's right or wrong, that's not what I'm opining on. It's just a reality of what's going on, and that's contributing to the decline in home ownership. In addition to, of course, the inaccessibility, the financial inaccessibility. So
Very European.
yeah, so it's kind of a sad thing because I think owning a home is one of the best ways for families to build themselves into wealth. With that being said, I think if you're a savvy, sophisticated investor, owning a home is certainly not the best use of your capital. I think even though you are a single family fanboy, we can say, I think even you recognize that a savvy investor is better off investing in more sophisticated strategies, more professional investments rather than sitting on a home, with the caveat of having access to very good financing in the single family space, right? That's an individual with a personal guarantee on a mortgage can get, especially if they live in it, right, for their primary, they can get very good debt. So that's one advantage. But by and large, of course, to talk our own book, investing in multifamily is a superior way to go than investing in single family if you have an aggressive value add plan to generate equity.
Absolutely. And the reason why I want to do it, it's not going to be everything that I do. And kind of my plan is, buy it, fix it, rent it. They say burr, of course, but my plan would be to take my house that I bought with 15% down. I'll have probably 20% equity by the time I move out, and buy another house, roll my commission into it, and basically put another maybe very minimal amount of monies down, and then renovate it, upgrade it, and then refinance it, turn it into a rental, and play that game in conjunction with everything else. But if I can put basically 5% down, that's really attractive. If I can get that leverage, that's how when you're young, that's a great strategy, and let those houses ride. And then obviously so much of my net worth will just be tied into Lone Star stuff anyways. So it's a nice way to have a switch and a slight diversity.
Yeah. And also, one thing my dad always used to say is owning a home is a forced savings account because you have to make that mortgage every single month. So if you put 5% down and sign up for a 95% mortgage, that's a beast that you have to feed every single month. You have to make the money and you have to save it. And if you buy in the right area and you get that appreciation that you're looking for, that savings account's going to pay off nicely over time as you put in money. Scary thought would be, you get this mortgage, you put in money every single month to pay that mortgage, and then the appreciation isn't there. There's risk in life. So that's also something to consider. I think there's kind of this fallacy, if you will, two fallacies that I think a lot of people have in America specifically, is that the stock market always goes up and real estate always goes up, right? Over the long term, that is true. That has historically been true, but there have been nasty periods of history where you could go 10 years of choppiness and really not see anything for it. So it's
Stagflation was what we've seen before.
Yeah. So it's never easy. Making money is never easy, as we say.
No. And I think it's all timing and where you're at in life and what you can do. But to your point, I just know my maturity as a man changed a lot when I had a debt obligation personally. You look at your money differently, you look at your spending differently, you look at $10,000 and it's like, am I going to go on a trip? It's like, no, I'm going to remodel a bathroom, or I'm going to do, landscaping, or oh, wait, no, I'll save that for a rainy day because what if one of my air conditioning units in Scottsdale goes out? Kind of need to fix that, right? So it's interesting in that regard to your point. Question for you, Mr. Manhattan. Do you plan on maybe owning a place yourself at some point in the city? Or are you going to be a renter forever in that regard? And New York's obviously one of those places where most people are the latter. They are renters forever. Yeah, you control there's some bacon, a lease that's very economically affordable if they are there for 20 years, which a lot of people are there for, extended periods of time. But what would your plan be, do you think?
Sure. So I'll share my plan, and then I'll also kind of share something that I think is fascinating that people probably have never thought of, or if I say this, they won't believe me. But the reality about New York, I'll say this it's kind of a hook, but rents are really, really cheap in New York. Renting is cheap in New York. Do you believe me?
No, actually, I believe the opposite, because I think my mortgage would get you a shoebox in New York. But
Right. So everyone thinks that New York is in fact the most expensive city in the world, and rents are very, very high here. However, renting is very cheap in New York compared to owning a home or owning your condo. So renting is actually, I'll say it again, renting is actually very cheap. Let me explain. Uh, my we'll just use my example. My dream apartment is $10 million, let's say. Maybe it's 10, maybe it's 12, but let's just make it simple. It's $10 million is my dream apartment. And if I were to put $2 million down or 20% down, have an $8 million mortgage between HOA, taxes, insurance, everything, it would be a call it $75,000 a month mortgage payment every single month. So I'd have to put $2 million down and have $75,000 a month in a payment. Conversely, that same $10 million condo can be rented for somewhere around $30,000 a month. So what sounds cheaper now? Putting $2 million down and then 75 grand a month, or the $30,000 a month? Now, I know all the smart people are thinking, oh yeah, well, what about the equity? Okay, fine. Yes, you could absolutely make equity by putting the $2 million down, paying the mortgage, and your $10 million condo could be a $15 million condo in 5-10 years if you're lucky, right? That's if you're willing to make that bet that New York real estate will appreciate. A lot of people think that New York is a dumpster fire and that it's going to collapse, so maybe it doesn't go up in value, your $10 million condo. So that's actually the reality of the market, and the reason for that is because cap rates are so low in New York. So wherever cap rates are low, what is a cap rate? A cap rate is the property's income relative to its value. So where cap rates are low, it actually makes less sense as a owner occupier to own the real estate. If the cap rate's super high, why would you pay a very high rent relative to the property's value? You could just buy the property and probably have a lower mortgage than the rent amount, right? So that's the economics behind renting versus owning. Owning never makes sense in New York. Renting's always cheaper. The reason why people own in New York is for non-financial reasons. And that's the same reason why I will eventually own in New York, for non-financial reasons. I will own because I want the pride of ownership. I want the security. I want it to be my place that I can renovate if I want to, never be kicked out, right? That's why people own primarily in New York. So I think that is an interesting realization that not a lot of people have considered.
That's a very in-depth breakdown. And it's funny, New York is not the most tax-friendly state. I don't know if anyone has mentioned that before or has heard that, but it doesn't rank very low. Obviously being sarcastic, but yes, it's a very tax comprehensive state. And in addition to that, one thing New York has that makes things challenging as a homeowner too is your property tax is assessed every single year and goes up every year. So places like California, actually, you get locked into your property taxes at a certain rate, which if you're older and whatnot, actually makes things a lot easier for grandparents and things of that nature. It definitely ruins the velocity of the market. but it makes ownership in New York furthermore that much more difficult. Texas and Florida really high property taxes, same as Washington, Tennessee, and I'm sure Nevada. But guess what? You don't have income tax, so you win somewhere. There's no real winning in New York if you make a lot of money, I guess, other than the fact that you make a lot of money.
There's always
And
a way to win. Winners always win.
exactly. And speaking of money and whatnot, we're going to segue into the final topic, which is watch talk. So I thought you were going to get this, and then I didn't know when. And then I so happened to see you slip something on your wrist, and it took all of 5 minutes for me to notice a change in your appearance. Yeah, I'm very detail oriented, as you can tell, of course. And there was a special something on the wrist. So can you let us know what time it is?
Sure. Yeah. So Craig spotted that I had a new watch on today in the office. I just bought the Patek Philippe 3712 in steel. This is at this point now considered a vintage Nautilus from 2006. It's a very, very special piece. Only about 700 were made. And I'm getting way too nerdy for most people to care at all. I see you're on your phone. You don't care at all. But
No.
this watch is very special, and I was very excited when my uncle found it for me. I told him that I wasn't quite in the market for it just yet, but through a relationship back in Moscow, I'm my mom's side of the family is from Moscow, and so my uncle actually what's really cool is my uncle who sourced this watch for me growing up really looked up to my mom's dad, so my grandpa. So my grandpa growing up, he was my best friend. He unfortunately died when I was 6, but my grandparents moved from Moscow right when I was born to California. And so I pretty much grew up in the basement where my grandparents lived. So we had 3 generations in one house, grandparents in the basement, family, me and my sister. And I actually learned to speak Russian before I learned to speak English because I was spending all my time down in the basement hanging out with my grandpa. And so my grandpa back in Russia was a jeweler. And so he actually, to show people who are watching this on YouTube, he actually made this bracelet for my mom. And so I stole this from my mom and have been wearing it for over 10 years. So as a kind of a memory of my grandpa as well as my mom, because it was hers. So it's so cool because at this point, I don't really remember my grandpa, right? I knew that we hung out all the time and, he was my best friend, as I say, even though I don't really remember everything that went on. So it's so cool to hear the stories from my uncle back in Russia. He said my grandpa was the coolest guy ever. He always had a nice watch on, always had a cool Mercedes and would pull up. And he was telling me of this story where he came to some sort of Sunday gathering and he just kind of popped in, strolled in, said hi to everybody, cracked some jokes over here, chit-chatted over there, and then just made his rounds, and then he zoomed out. And then at the end of the night, when it came to the bill, they said, "Oh no, the guy that came a couple hours ago, he paid for everyone already."
Sounds like
So
someone I know.
that's where I get my coolness from. That my grandpa is so cool. It's amazing to hear the stories from my uncle. And my uncle was a kid. My grandma actually the other day was telling me about how he would kind of come around the jewelry shop. He was 9 years old and checking things out and whatnot. And now my uncle is just filled with so much joy, like true joy when he gets to see me filled with joy buying watches together, and we get to collaborate. And he's a Patek Philippe expert, and so we are having a lot of fun together. So yeah, that's a little bit of insight on kind of the history of my family and the watches and that I'm enjoying so much right now.
I love that story. With that said, did you trade in anything? What's your portfolio like, and what's next?
So yeah, I did. I actually made a trade with the dealer on this watch. I traded in a rose gold Yachtmaster on Oysterflex. So that's a really, really cool watch. Amazing pickleball watch, if you will. I love to wear that watch while playing pickleball. But you can wear a Rolex while playing pickleball, but you can't wear a Patek. So don't do that. I
Well,
made that
that's such a
mistake.
limiting belief.
Well, if you're a real big boy, you wear an RM or a Richard Mille when you play pickle.
We're an Aquanaut playing pickleball.
Yeah, it's delicate. Pateks are very delicate. If you're stranded on an island, or if you're lost in the forest, you want a Rolex on, not a Patek. That's for sure.
You want to Explorer too, or ideally, what I'm shooting for, which is the GMT Batgirl or Batman.
I'm inquiring on that piece for you, so we'll stay tuned on that. So yeah, so
My
I traded
wrists,
in the Yachtmaster.
wrists are a little naked.
Yes, a little bear. So yeah, so maybe in the next few episodes or something, I can share some of the other pieces that I have or that I'm working on. But yes, watches are a very big passion of mine, and it's a very fun journey to be on. And also, actually, what's really funny is everyone who knows about Lone Star and invests with us or works with us, they know about Kent, right? Who is my business partner, right? He's the other founder of the firm, but very few people really know him, right? Because he stays so much in the background. Well, the cool thing about Kent is maybe one day we will get him on this podcast. But the really cool thing is he's also, yeah, fingers crossed. The cool thing about Kent is he's also a watch fanatic like me. So we get to bond over watches, which is a very amazing thing when you are, working together. And also, frankly, just to share a little bit more, when Kent and I first kind of got together, we had such a big age gap. I was about 20 and he was maybe 37, 38. And so there not much that we can connect on, or we don't have very many similarities. And so watches has been a great thing that we can kind of really share and enjoy with each other as we grow our fantastic relationship.
Well, and it's great that you like watches, because if you were in a car city like Miami or, Scottsdale or Dallas, Los Angeles, you would probably use that income on a depreciating asset. But your watches, if you buy them at the right time, I mean, obviously like real estate, you can make, good money on them, but they're very awesome in the sense that there is an appreciation quality to them. And it's kind of funny. You can't bring X amount of dollars to an airport, but you can bring a nice watch. So
Watches have a lot of cool features about them. I can't wait to see you get your first Rolex. So it's going to be really, really special.
yeah, it'll be cool. One day at a time. Let's just get through the deals we're doing right now, and that'll all take care of itself, shouldn't it?
That's correct. That's correct.
Any other topics you want to cover on Watch Talk?
I could talk about watches all day, but I think people have heard enough. So we will, I think we should end it here.
Yeah, absolutely. Well, real quick, to the people who've reached out to us, there's several last week, which I'm really humbled by. It's nice to know someone's listening. People asked about the portfolio and our transparency, so I promptly got back to them. If you have any questions for the mailbag, we're actually developing a bunch of questions coming up, so we're just kind of sifting through them, and they'll probably have a mailbag episode soon. But please send any questions that you may have. As mentioned, the blood drive is coming up. It is August 15th. Tuesday, August 15th, I believe, from 11 to 4 p.m. In the office. Please come by, donate blood, save lives. Saving lives is cool. And then our conference, October 15th to 17th. If you're looking to learn more about Lone Star Capital, please reach out to myself. My email is craig@lscre.com for any inquiries regarding that. If you're looking to maybe raise capital, if you're looking to, become an LP investor, anything like that, reach out to us. We're always happy to connect. Thank you so much for your time today, Rob. Always a pleasure, and congratulations on the newest acquisition. No, I'm not talking about Azul, but I'm talking about your wrist. Congratulations, and we will hopefully see you next time on episode 9.
Excellent. You killed it. Thank you.